Over the last year, we've seen governments around the world airdrop billions of dollars to their citizens in an attempt to offset some of the economic impacts of the pandemic lockdowns. Now, while that money was intended to be used to pay for things like food and rent, some of it managed to find its way into crypto. This has led many to wonder just how big of an impact all those Stimmy checks have had on the crypto market. It turns out that the United States Federal Reserve has been wondering the same thing, and they recently published a study which had some surprising results and some even more surprising regulatory recommendations. Today, I'm going to tell you all about what the Fed's Stimmy study found, what regulations it suggests, and what it could mean for the crypto market in the future. Before we turn on the money printer, I need to give you a disclaimer. Do not make decisions about your portfolio based on anything you see in this video. That's because I'm not a licensed financial expert, so taking my words as the gospel of truth could get you hurt. Remember to always do your own research. If you've come to this video by chance or on purpose, my name is Guy and I'd like to welcome you to my crypto universe. The crypto content on this channel is some of the highest quality you'll ever see. Coins, tokens, news, reviews, market moves, I cover whatever comes to me. If you're also waiting for fiat to fall, subscribe to the channel and click that notification bell and select all. Feel free to use the timestamps down below to skip ahead if you see anything you already know. I'd love it if you watched from the beginning to the end. Better yet, share this video with a friend. So, now that we're fully synchronized, let's see if the stimulus checks really did take the crypto market to new all-time highs. The study I'll be discussing today was written by the United States Federal Reserve, specifically the Federal Reserve Bank of Cleveland. As a quick refresher, the Federal Reserve is the privately held, quote, independent entity within the US government, which issues Federal Reserve notes, aka US dollars. The Federal Reserve Bank of Cleveland is one of the 12 regional banks which collectively make up the Federal Reserve System in the United States. And fun fact, the Federal Reserve Bank of Cleveland has the largest and heaviest vault door of any bank in the world, which can be seen here. This monster weighs over 91 metric tons and is no longer in use. Anyways, what makes the Federal Reserve Bank of Cleveland different from the other Fed branches is that it is the only one which handles collections for the US Department of the Treasury. In other words, they provide the payment system that the US government uses to collect taxes and pay back government debt. This seems to include any payments made by individuals or institutions to the US government. The Federal Reserve Bank of Cleveland also, quote, supports the Treasury's objective of expanding the use of digital products and payment services across the federal government. It shouldn't come as a surprise, then, that many of its constituents are interested in crypto, and two of them recently released the study I'll be discussing today. This study is titled, quote, Uncovering Retail Trading in Bitcoin, the Impact of COVID-19 Stimulus Checks. I reckon that's pretty self-explanatory. Now, in contrast to academic studies, this Fed study is actually technically a working paper, which will be circulated among all Federal Reserve officials for them to discuss, according to the second page of the paper. So, with all this context in mind, let's chow down. The first section of the Fed's Stimmy study lays the groundwork for the entire paper. It starts off by noting that the Fed was inspired to analyze the effects of Stimmy checks on the crypto market after a tweet by Coinbase CEO Brian Armstrong in mid-April. The tweet in question features an image which shows that there's a huge spike in buy orders and deposits on Coinbase in the $1,200 range. Now, for those who don't know why this figure is significant, $1,200 is how much every American was eligible to receive as part of the CARES Act, which was passed at the end of March 2020. Naturally, the CARES Act sought to offset some of the economic damage done by the pandemic to individuals by giving them a, quote, economic impact payment, or EIP. Now, because EIP reminds me of Ethereum's improvement proposals, I'll continue to call them Stimmy checks to keep things simple for me and any other Ethereum fans watching. As explained in the second section of the Fed's Stimmy study, every single adult in the United States earning less than $75,000 per year was eligible to receive a no-strings-attached Stimmy for $1,200. Those making between $75,000 and $99,000 per year were still eligible to receive some Stimmy, but this amount approaches zero as their income approaches the upper income limit. Given that the median salary in the United States is only around $36,000, the vast majority of adults were eligible to receive some helicopter money, and 7 out of 10 received their Stimmy by the end of May 2020. This totaled nearly $270 billion, which was just 10% of the over $2 trillion the CARES Act eventually pumped into the US economy. Around that time, both the stock market and the crypto market accelerated their recoveries from the massive crash in early March, which is believed to have been caused by the World Health Organization's announcement that a pandemic was indeed upon us. Interestingly enough, the rally out of the hole began long before the Stimmy checks started being sent out. The Fed believes that the mere announcement of monetary measures was enough to jumpstart the recovery in asset markets. Though there have been 2 more rounds of stimulus payments since last year, the Fed's working paper only focuses on the first round of stimulus, which went out last March. The third section of the Fed's Stimmy study details the methods they used to determine how much of an effect the stimulus checks from last spring had on the price of Bitcoin. First, the Fed took trading data from Kaiko about BTC buy orders on 26 cryptocurrency exchanges between January 1st and June 5th, 2020. Then they identified any buy orders at the $1,200 range and divided the initial timeframe into 2 periods, January 1st to April 9th and April 9th to June 5th. This is because the first round of Stimmy checks were sent out on April 9th, and the remainder were distributed in the weeks that followed. Logically, the Fed predicted that there would be more $1,200 BTC buy orders between April and June than between January and April. The number of these orders could then be used to estimate how much Stimmy money made it into Bitcoin. Now, obviously, there are a lot of confounding variables here, and the Fed actually did a pretty good job of accounting for most of them. For example, the Fed considered the possibility that the stimulus amounts could be larger than $1,200 if the recipient has 1 or more children. The Fed also factored in the fact that some Stimmy recipients might choose to put in just a portion of the money they received rather than the full amount. Others may not have received the full $1,200 due to having a higher income. And last but not least, the Fed accounted for all of the fees charged by various cryptocurrency exchanges, which could take a few digits off that $1,200 deposit. To account for the first variable, the Fed analyzed other Stimmy payment amounts that could have been received by people with children. They also pointed out that research suggests people with children are unlikely to invest any extra income into speculative assets. More importantly, they highlighted the fact that most cryptocurrency investors tend to be young and single. To account for the second variable, the Fed likewise analyzed multiple price points besides $1,200, notably $1,000, $600, $500, and $100. They also pointed out that research suggests people will invest using round dollar values during periods of uncertainty and/or when the asset is volatile. The pandemic is uncertain, and Bitcoin is volatile, so go figure. To account for the third variable, the Fed lumped BTC buy orders between $1,150 and $1,250 into the same category of $1,200 range. This is because the largest exchange fee for that amount is $50, and the exchange in question is obviously Coinbase. The 4th, 5th, and 6th sections of the Fed's Stimmy study reveal the results for their various hypotheses. The first finding is that the number of BTC buy orders at the $1,200 range on cryptocurrency exchanges spiked as soon as the first round of stimulus started being received on April 9th, 2020. The second finding is more significant, and that's that the amount of BTC buy orders at the $1,200 range spiked on May the 8th, the last business day before the Bitcoin halving. The Fed believes this is due to the media attention Bitcoin received during that time because of the halving event. The third finding was about one of the confounding variables, specifically the possibility that stimulus recipients with children invested their increased allocation into BTC. No additional investments were found at those price levels compared to the pre-stimulus time period. The fourth finding was that most of the stimulus money used to buy BTC was sent to Binance US, Coinbase, and Kraken. These are the most popular cryptocurrency exchanges for retail traders in the United States, according to the Fed. The sixth finding was about another confounding variable, specifically that most people only invested a portion of their Stimmy, primarily around the $1,000, $600, $500, and $100 ranges. Although there was an uptick in BTC buy orders at these ranges compared to the pre-Stimmy time period, this difference is not as big as with $1,200 BTC buy orders. The last findings relate to the impact of Stimmy payments on the price of Bitcoin, and these are nowhere close to the magnitude that you'd expect. Of the nearly $270 billion of stimulus money that was sent out to Americans, only about $58 million found its way into Bitcoin between April 9th and June 5th. Now, this might sound like a lot, but it's barely enough to push up the price of BTC by 5% on a single cryptocurrency exchange, much less the entire crypto market. Not only that, but this Stimmy money was invested over the course of many months, not a single day. According to the Fed, Stimmy payments only accounted for 3.8% of BTC trades by number and 0.7% of trades by value during that time period. In terms of actual price, all the Stimmy buy orders they analyzed, $1,200, $1,000, $600, $500, and $100, only managed to push up the price of Bitcoin by 0.22% between April 9th and June 5th. If you isolate the $1,200 payments, that BTC price pump drops to just 0.05%. So it just goes to show you that there are much bigger things that move the crypto market, and I happen to have a video all about them, and you can find that up there in the top right. The seventh section of the Fed's Stimmy study is perhaps the most fascinating, as it involves a brief analysis of the effect of stimulus payments in other countries on the price of Bitcoin. The Fed looked at 3 countries for which there was ample exchange and stimulus data during the United States' own funny money-making period. These are Japan, Singapore, and South Korea. After briefly detailing the stimulus amounts that were afforded to the residents of these countries, the Fed goes on to contrast the BTC buy orders placed for those amounts before and after they started being sent out. They cast a similarly wide net to account for exchange fees. Now, the Fed found that the number of BTC buy orders for foreign fiat-denominated Stimmy amounts spiked in Japan and South Korea, but not in Singapore. They chart this up to a relative lack of trading volume for the Singapore dollar BTC pair on exchanges there. In Section 8 of the study, they quickly check 2 metrics to make sure that the effects they're seeing are coming specifically from US stimulus. The first metric is BTC sell orders at or near the 1200 range, which would suggest that there is some unknown third factor that's driving market activity at that price point from both sides. Not surprisingly, they did not find any changes in BTC sell orders between the pre- and post-Stimmy timeframes. The second metric was much more interesting, and that was the frequency of $1,200 trades denominated in another currency, specifically the euro. If there was also an uptick in similarly sized BTC buy orders denominated in euros, it would again suggest that there is an unknown third factor at play. They again found no evidence of this being the case. In other words, the increase in BTC buy orders at the $1,200 range was almost certainly caused by US stimulus money. The 9th section of the Fed's Stimmy study lays out a few final conclusions, as well as some regulatory recommendations for future stimulus programs. The main takeaways are that only 0.02% of all Stimmy checks were spent on Bitcoin, and this means that, quote, policymakers should not be concerned about money being diverted to cryptocurrency markets when considering similar economic relief programs in the future. This is certainly good news, but I can't help but notice that this conclusion isn't exactly correct. That's because Bitcoin is just one of many cryptocurrencies that make up the crypto market, and it doesn't even account for the majority share by market cap. It's possible that some of last year's Stimmy money ended up in altcoins, and I would argue that this amount is probably larger than the $58 million that went into Bitcoin. My first piece of evidence for this is a study conducted by Coinbase in May 2020, which found that 40% of retail investors buy altcoins instead of Bitcoin, and more than half of those who buy Bitcoin buy altcoins eventually. When you put those numbers together, a whopping 76% of crypto investors put their money into altcoins eventually. Unlike BTC, which requires tens of millions of dollars to change its price on any given day, sometimes even just a few $100,000 is more than enough to move an altcoin up or down by double-digit percentages. This means stimulus-driven investing could have had a significant impact on the price of select altcoins while having a negligible effect on Bitcoin's price. My second piece of evidence for Stimmy-driven altcoin investing is the Bitcoin dominance chart. You can see that there was a significant dip in Bitcoin dominance in April, which is exactly when the bulk of those stimulus payments were sent out. Now, correlation certainly doesn't equal causation, but it's quite clear that the average retail investor of today isn't as crazy about Bitcoin as in previous bull markets. Look no further than Dogecoin for evidence of that. Although the Dogecoin craze wasn't around last year, the juvenile belief that investing in an altcoin with a low dollar value means you'll become a millionaire definitely was, and it's probably been around since the first altcoin was created. As I've mentioned many times before, just because a cryptocurrency has a low dollar value doesn't mean that its price can be easily pushed up. This all depends on the market cap of that coin or token. When new investors enter the market, however, they see Bitcoin's price and think, there's no way I can afford that, but wait, I can see that there's this AMP token trading on Coinbase for a few cents. If I buy that and it becomes as big as Bitcoin, I'll be rich. Now, this all ties into the broader topic of tokenomics, which I covered in depth in a video you can find up there in the top right. Of all the crypto reports and studies I've analysed so far, this one is probably the most significant. Besides the fact that it was conducted by the United States Federal Reserve, it underscores just how small of an effect retail money has on the price of Bitcoin. To move a $1 trillion asset, you need trillions of dollars, and that's something the average person doesn't have. One thing that I didn't mention earlier was that the Fed's Stimmy study found that most people use any extra money they get to pay down debts. This is understandable, given that apparently over 80% of people in the United States are drowning in debt, including the US government itself. Perhaps this is playing a role in the average person's propensity to invest in altcoins rather than Bitcoin. If you're already in a hard place financially, throwing a few $100s at a mountain of debt probably isn't going to do much, but putting that same amount in the right altcoin could make all that debt disappear. As much as it sucks that the Fed probably won't be able to tease out how much of that Stimmy money went into altcoins, at least they won't be able to see just how much of it ended up in shitcoins. What I would really like to see is a Fed study that estimates where those other $2 trillion or so of stimulus really ended up. But something tells me we won't be seeing that study anytime soon. That's a wrap for today, folks. If you liked what you saw, be sure to pound that like button with your paw. Take a minute to subscribe to the channel if you have yet to do so, and ping that notification bell to stay in the know. Until the next one hits the tube, you can follow me on Twitter, TikTok, and Instagram too. If you're in need of daily crypto market updates, join my Telegram channel and make sure you're in the right one because there are a lot of fakes. If you want a peek of my personal crypto holdings, subscribe to my free weekly newsletter that's tailor-made for crypto queens and kings. You can even look like one too if you head on over to the Coin Bureau merch store and buy a tee or two. You can find your way to my socials, Telegram, newsletter, and merch store using those handy links down below. Thank you so much for your time. If you made it this far, your commitment is mighty fine. I'll see you all real soon.